Forget everything you're hearing about the housing market. Seriously, we are on the verge of the single greatest transfer of commercial wealth since 2008, and it's happening right under our noses. It's happening in buildings many of us used to work in every single day. And this entire fundamental reset, well, it all comes down to one truly massive number.
Yep, you're seeing that right. $1.8 trillion. Now, this isn't just some big number I'm throwing out to shock you. This is a ticking time bomb. It's a giant wall of debt that was signed and sealed in a world that, financially speaking, doesn't even exist anymore. And its due date is coming up fast. This is the catalyst for everything we're about to talk about.
Okay, so here's our game plan. First, we're going to look at how we got into this mess, what I'm calling the cheap money hangover. Then we'll look straight at that $1.8 trillion wall of debt. We'll break down exactly why refinancing is pretty much impossible for so many. Then we'll get into the brutal truth about what makes a property valuable today, see how this all rhymes with 2008, and most importantly, we'll lay out the playbook for investors who actually see a huge opportunity in all this chaos.
To really get what's happening now, we have to jump in the time machine and go back a bit. Right after the 2008 crisis, the Federal Reserve basically turned on the money hose, pushing interest rates down to almost zero for more than a decade. And all that cheap capital? It fueled this just unbelievable boom in commercial real estate.
I mean, think about it, right? If you can borrow money for practically nothing, you can afford to pay way more for buildings. Entire business models, the valuations of these properties, investment strategies, they were all built on this one critical assumption that cheap money would be here forever, that you could always just get another low-rate loan when your old one was due. Well, that assumption is about to be proven catastrophically wrong.
And that brings us to the main villain of our story, the wall of maturity. See, this isn't just any old debt. We're talking specifically about short-term commercial loans, the 3 to 5 year kind, that were written right at the peak of that cheap money party.
This timeline just lays out the collision course perfectly. From 2019 to 2021, loans were practically being given away with these rock-bottom rates. Then, boom, 2022 happens. The Fed doesn't just tap the brakes to fight inflation, they slam on them with the fastest rate hikes we've seen in decades. So now, coming up in 2025 and 2026, all that old, cheap debt is maturing in a new, brutally expensive world.
So the big question is, why can't these building owners just refinance? I mean, it sounds simple enough, right? Just get a new loan to pay off the old one. The problem is, the new math just doesn't work. It's impossible. And it all comes down to one single critical metric that every lender lives and dies by.
It's called the Debt Service Coverage Ratio, or DSCR for short. It sounds complicated, but it's not. All it is a simple safety check. It answers one question for the bank. Does this property make enough money to comfortably cover its mortgage payments? And lenders, they need a cushion. So they're going to want to see that the property makes at least 20 to 25% more than the mortgage payment. That's their number one rule.
And the calculation is really straightforward. Step 1, you take all the rent money coming in, you subtract your operating expenses, like taxes, insurance, upkeep, and that gives you your net operating income, or NOI. Step 2, figure out what your total mortgage payments are for the year. And finally, step 3, you just divide your income by your mortgage payments. That's it. Simple, right? Okay, this slide. This is where the whole crisis becomes crystal clear. Let's take a hypothetical office building. It's the exact same building in both columns, making the exact same $1 million in income. On the left, back in 2021, with a 3.5% interest rate, the DSCR is a healthy 1.28. The bank says, approved. But now, look at the right. The owner tries to refinance into today's 7.5% rate. The mortgage payment explodes. The DSCR absolutely craters to 0.74. The income doesn't even cover the new loan. The bank says, denied. Instantly.
And this broken math leads to this really dangerous financial state called negative leverage. All this means is that your cost to borrow money is now higher than the return you're getting from the property. In other words, the debt is now actively destroying your wealth. For thousands of owners, their buildings went from cash-flowing assets to financial anchors, just pulling them straight underwater.
Which brings us to probably the single most important lesson of this entire reset. For decades, we have all been told the same thing, that the 3 most important things in real estate are location, location, location. Well, I'm here to tell you that's not true anymore. So, I want you to imagine you own a building just like this one. It's beautiful, a Class A trophy. It's fully leased up with amazing tenants right in the best part of town. By every traditional metric you can think of, you've totally won the game. But none of that matters. And this is the brutal truth.
A great building with a bad loan is a zero. If the capital structure is broken, if that debt can't be paid and it can't be refinanced, the owner's equity is completely gone. It's wiped out. The location, the tenants, the beautiful lobby, it's all irrelevant. The loan is everything.
Now, if this whole situation, bad loans, triggering a massive crisis, feels a little familiar, it should. We've definitely seen this movie before. But even though there are echoes of 2008, the epicenter of this earthquake has shifted. A lot.
The crisis back in 2008 was almost all about subprime loans on regular houses. This time around, it's all centered on commercial real estate debt, and the pain is especially bad in places like older, Class B office buildings. I mean, those places got hit with a double whammy. Not only are rates high, but they're also dealing with huge vacancies from the whole work-from-home shift. That drop in occupancy just crushes their income, making it basically impossible to pass that DSCR test we just talked about.
So with all this talk of doom and gloom, you might think the story just ends with a bunch of foreclosures. But for investors who are prepared, for those who have cash ready to go, this crisis isn't an end at all. It's a new beginning. This is where the chaos creates an absolutely incredible opportunity.
Okay, so where's the silver lining in all of this? Well, when these owners can't refinance, they're stuck. They've basically got two choices. Give the keys back to the bank or sell. Sell at a massive discount to someone who can come in with cash. And that forced selling, that is what creates the opportunity.
And this is the core concept right here. We're not talking about a little 10% market dip. This is a full-on basis reset. The fundamental value, the cost basis, of these buildings is being completely repriced down to what the new high-interest rate world can actually support. It's a chance to buy incredible buildings not with a bad loan, but with cash, at what could be a generational discount.
One of the most direct ways you can see this playing out right now is in the stock market, with publicly traded real estate investment trusts, or REITs. Just look at this table. Some of these companies are trading for way less than what their actual properties are worth. Check out that top row, Office REIT A. Its price-to-book value is 0.60. That means the market is letting you buy their entire portfolio of office buildings for just 60 cents on the dollar. It's wild.
But, and this is a huge but, investing in this kind of market needs a totally new playbook. Your research has to shift away from just looking at the physical buildings and focus intensely on the financial statements. You've got to become an expert on their debt schedule, see when those loans are coming due. You have to check that price-to-book ratio, make sure you're actually getting a discount. And maybe most important, you have to dig into their loan covenants to make sure they aren't about to get in trouble with their lenders.
And really, that's what this all boils down to. This $1.8 trillion wall of debt is forcing a great reset of values across commercial real estate. The old rules are out the window and a whole new game is starting. So the only question that really matters now is, when this all shakes out, will you be the one writing the checks, or will you be the one handing over the keys?